Yo, what's up, everybody? It is Thursday, August 15th. Another blistering day up in the stock market. Very strong day. And I'll get into the economic data that supposedly triggered the rally. At least that's what is being put out there as the explanation. But before I get into that, I'll just mention the fact that between yesterday we had a Social Security payment. Today we had a quarterly interest payment. I've been telling you guys that was going to happen. We were going to have a surge in the fiscal flows. The fiscal flows are in the process of peaking out for this cycle. Today was a major flow with that quarterly interest payment, probably between yesterday's Social Security payment and today's quarterly interest payment, probably looking at like an 80-something billion net flow. I mean, 84 billion maybe net flow in the last 2 days. That's a lot of money coming into the economy. So, I mean, that gets dispersed into the stock market, at least some of it. That's a powerful wave of, financial pressure. And so it's totally understandable to see the market go up like that. Now, the news, the economic news this morning, that was a 1% increase in retail sales for July, and they were expecting to see a 0.4% increase. It was a 1% increase. So that was pretty strong. That's strong, actually. I have to point out, or I have to mention the fact that not too long ago, a strong economic report would have been a trigger for selling by the monetarists, but they've kind of tossed that away now because now it's suddenly being construed as, oh, well, we're not going to go into a recession, which before that was also like a negative signal for the monetarists. But it's funny for me as also not just an investor or a trader of the markets, as an observer of behavior and as an observer of the narrative. Whenever I see this kind of like the narrative switches to support whatever the short-term trend is, okay? I mean, we've seen this in so many different instances where the narrative can be, for example, the monetarist theme, where is the Fed going to cut interest rates? Then it could flip over to, is it the economic growth outlook? Then one day it might be the geopolitical situation. Then it might be some utterance of some Fed official that ends up in a headline. So I've done many videos on how you have to keep your perspective. Perspective is very, very important. And at these times, it pays to go back and revisit and think about what was happening, for example, in October 2022, when the market was crashing, when it bottomed out. And back then, in the lead up to that bottom, I was making the videos and saying, we're going to reach an inflection point. The interest income transfers from the rate increases are going to be very, very positive for the economy. It's going to be very, very positive for the stock market. But back then, at that time, I could remember like any headline or any piece of economic data that came out was always construed as a negative, okay? I mean, it was the economy was slowing down, or the Fed's going to raise interest rates, or they're going to shrink their balance sheet and it's going to, suck out the liquidity from the economy. We had all those narratives, and if one, started to get a little old, and they would roll out another one to support whatever the short-term market trend was. And we're seeing the same thing now. I think this bounce that we've had off the lows, and I admit it's been very impressive, but again, we're coming into the peak in the fiscal flows for this cycle. Sorry that I have to repeat that so much, but it's actually what's happening. The bounce has been very strong, and it is kind of transitioned from the Fed rate cut. And by the way, let me speak to that in a minute as well. It's transitioned from the Fed rate cut now to the explanation is, oh, we're not going into a recession. And, you know, like I said earlier, recession talk used to be bullish for the stock market because the monetarists would cheer, hey, we're going to get a rate cut or several rate cuts, and that's going to be bullish. Let me talk about that rate cut situation, because last Tuesday, when we had that 1,000-point sell-off in the market, you had people saying the Fed needs to do an emergency rate cut, like right now. They need to do 50 or 75 basis points immediately. And then when the market kind of stabilized, we saw in the Fed Watch tool at Fed Fund Futures, they were then pricing in a 50 basis point rate cut in the September meeting, okay? And now that the rally has endured this long, and it's been a very powerful rally, there's only a 25 basis point probability baked into the market right now. So I'm wondering, by the time we get to the Fed meeting, which is in September 18th, there might be no expectation of a rate cut the way this thing is bouncing around. And the reason why I point this out is because, you know, if you go about your investing with this kind of jumping in and jumping out, and one day one thing means one, you know, something, and the next day that same thing means another thing. It has a different meaning attached to it. I mean, I hope you can see that this is just some kind of insanity. I mean, you have to be consistent. I think as a savvy investor, if you're going to claim to be a savvy investor, you have to be consistent in your approach, all right? In the analytical framework that you use. You can't keep redefining what it means. You got to be consistent. And that's what I try to do here. I try to be consistent. I'm telling you, there's a peak in this cycle, in the flows cycle. It's not the end of the flows, but you get these quarterly peaks, all right? We're going to go into, we had this big day yesterday and today with these transfers, with the interest payment and the Social Security. You're going to get September 1st, which actually those payments are going to fall on between August 30th and September 2nd. All right. And so the monetary environment from now until September 2nd, it's going to be plentiful. But that's the peak. Okay. And there's a reason why September and October are normally bad months for the stock market. And it's because it's tied to these flows peaks and, you know, vice versa, the flows troughs, like in mid to late October when things start to pick up again. So just keep that in mind. You have to be consistent. When I see this kind of stuff where they change the meaning on a day-to-day basis or a week-to-week basis, where something means something and then all of a sudden, no, it doesn't mean that anymore. You could tell it's a made-up thing. It's a fake thing, that there is not really a logic or a rationale behind it. Because if you have to change it all the time, then it doesn't stand up to the test. All right? I mean, to me, that just seems completely logical and easy to understand. Like, if you have to change it all the time, like one day it means this and then another day it means that, it doesn't stand up to the test. And you know that means that it's fake. It's just like a phony thing. It's a narrative that's made up to support whatever the short-term trend is right now. We know that short-term trends are dictated by emotional investors. We know, like last week, the stories were Warren Buffett, he was raising cash into this rally. And I'm sorry, but you cannot argue with his track record. I mean, there's nobody even close. I don't care even if you talk about and I've made many videos talking about these algo shops like Ken Griffin's Citadel, where they literally front run the orders, okay? Because that's what his firm does. He buys the order flow from TD Ameritrade and Schwab, and he has his computers situated at the New York Stock Exchange or the CME data center out in Illinois, and then they just they see the orders coming down the pipe. It's a legal form of front running. Frankly, in my opinion, it shouldn't be legal, but it is, because these guys, they buy off lawmakers in Washington, and they allow. I mean, at one time they were thinking about outlawing this practice, but that got shoved under the rug pretty quick. But what I was saying is, like, a guy like Ken Griffin, as rich as he is, he can't hold a candle to somebody like Warren Buffett. Warren Buffett understands value. And while he might not be right all the time, nobody could be right all the time, he's done an amazing, amazing job at amassing a vast amount of wealth by simply investing in stocks. He's not a trader. He doesn't use this kind of arbitrage or algo type of approach. He's a long-term investor in stocks, and everybody knows who he is and how much wealth he has amassed in the stock market. And so, like, you look at who's buying, you look at who's selling. The ones who are buying now, it's because last week it meant whatever their narrative was meant something. This week, whatever their narrative is, it means something else. So let me just repeat that we're in the peak of these flows for the cycle. Okay, it's not like these flows are going to crash down into nothing. Although, what I have been telling you is that we're about to enter into a very interesting and I think fun period where we're going to start to get interest rate cuts. And I've been telling you guys how that's going to play out. And I've been saying that it's not going to play out the way the monetarists and all the Johnny-come-lately bulls to the market think it's going to play out. And I've read some stuff online where it's like, don't buy yet. We've had this tremendous historic rally in the stock market and stocks. I mean, my portfolio has done fantastic. I've been raising some cash to prepare for a pullback when I could add some more. But I've read stuff like, don't buy yet. When are you going to buy? Wait till they cut the rates and then start buying. So you could see the quality of who's getting involved now. Okay, this is your casual, layperson who's not really very understanding about the economy or stocks, or listening to CNBC or something like that. I don't even know if CNBC, which I don't listen to, I don't even know if CNBC is saying stuff like, don't buy yet, wait. I mean, but to me, as a veteran, as somebody who's been in the markets for over 40 years, I mean, I just look at that stuff and I'm like, man, where were you the whole time? I tell you where they were the whole time. They were out like all last year. They were out all last year, and then they've been watching and watching and watching, and now they're waiting for the Fed to cut interest rates, and for them, that's the green light to go in. But again, you have to understand what is the effect of monetary policy changes. And the way it is portrayed, the way it is spoken about in the mainstream, they don't understand it. It's single variable analysis on their part. That's why they had it all wrong last year. Guys like Mike Wilson at Morgan Stanley and a lot of others. And so they're going to get another schooling. I'm telling you, it's going to be interesting. It's going to be fun. And we will come back and revisit this. By the way, with that 1% jump in retail sales, I just checked the Atlanta Fed's GDP Now forecast for the third quarter, and it's at 2.4%. So I think that's actually down from, we had a 2.8% second quarter report, right? Remember? And now they got it in at 2.4. But, we know that could bounce around. I mean, the second quarter, their forecasts were changed 23 times, if I remember correctly. So that could definitely bounce around. So anyway, that's the update for today. Please like and subscribe. And don't forget, guys, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. I'm the only one who does this. I have an applied approach to MMT. I take the concepts and understandings of MMT and I show you how to use that to invest and trade in the markets. Plus the mental game, behavior, perspective, the things I talk about. All right, see you tomorrow. Bye.